Bring in CNBC contributor Adam Parker of Trivariate Research, see what he makes of what Mr. Krinsky just said. It's good to have you back.
Thanks for having me.
You're not really a believer in the move higher that we've had in stocks anyway, right?
Well, I mean, I think the data points that we're looking at, from rates to speculation to valuation to earnings expectations, all look worse than they did 3 months ago. I mean, with Apple, I don't know enough about two-day technicals to dispute what he said, so I'll go with it.
But I mean, the biggest stock in the market having what looked to be some kind of breakout is not insignificant to you, though.
No, I just think it's the market ripped in the Q4 up 5-6%, and this thing was down, right? And now it's up a ton, and now it caught an upgrade from a big firm. So, sure, it's up today, but I don't think that means it's in better position. I mean, I looked at Apple a lot lately, actually, and one thing that really surprised me is in the last 10 years, their net income has only grown 9% a year. Right? If you told me 10 years ago it was going to grow 9% a year, I'm not even sure you and I would have sat here and said it was a growth stock. Now, they bought back 40% of their shares, and so it's been a monster. But, I don't know, looking out forward to me in a longer-term view, I don't know how I could like that versus like the energy sector, which is the same size. So, it depends on your horizon and what you're really trying to accomplish when you invest, but it doesn't make sense to me.
How do you size up what's at stake over the next, as we say, 13 trading days? You got Powell tomorrow on the Hill, kind of all eyes are on that, and maybe the fact that yields turned around today to move higher, maybe trying to get ahead of what could be more hawkish testimony from Chair Powell tomorrow. But then you got the jobs report, you got CPI, you got ECB, you got Fed decision. 13 critical days.
Yeah, I just think the risk reward, I mean, look, what we wrote in our note you saw this week was, what is the bull case? If I show up today and I think we're going to end the year 10% higher in the S&P and I want to really deploy some fresh capital at sort of 40, 50 round numbers, I got to believe in something close to 4,500, say at year end. What do I need to believe? Like, what is that bull case? I need sort of slowly declining inflation. I need the Fed to get less hawkish but pause and not ever, data get worse where they're going to cut. I need, sort of input costs to come down so the companies can expand. I mean, there's a lot of if I need sentiment and positioning to then therefore think things are going to be a lot better in 2024. It just feels like the risk reward skewed to the negative to walk in today and get very, very excited, just given how much worse the data looked than 3 months ago.
I mean, Fed done soon. Inflation down faster than people think. Earnings not as bad as feared. So that's that hard to put that story together,
I think it is. If the Fed's going to get dovish, I think that's going to happen because the economy and earnings are really going down.
What if they don't get dovish? They just get dunnish.
Yeah, I mean, so that's what people want. We had 20-something meetings, a couple of dinners with investors last week. Every meeting I said, what do you think the bull case is? It was tough. The Fed getting out of the way. So I said, well, what does that mean? What does them getting out of the way mean? I think that means you think they're pausing for a long time because we're in this Goldilocks zone of data on inflation and jobs. I mean, anything's possible, but that certainly isn't the highest probability outcome. I think the highest probability outcome is they stay hawkish until they can handle the services and wages part of the economy and get inflation much lower.
You still think the macro gets worse as we progress, like Marko Kolanovic at J.P. Morgan is talking about, right? He's one of those who was trying to be pretty bullish last year in the face of a lot of negativity. Then, as I've been saying, kind of saw the writing on the wall. And now he expects the macro to deteriorate. Wrote today, one strong day or weakened risk does not change our negative outlook that is predicated on weakening macro fundamentals.
I think we've had the same view on the macro part for 9 months. Erode, not implode, but not sure 24 earnings will be above 2023. So one of the reasons I got more worried a couple weeks ago is I think the 24 numbers are out and they're 11.5% earnings growth expectations. So now I know I'm going to have meaningful downward revisions in the second half of the year because I don't see a big, fiscal stimulus incremental or big, accommodative monetary policy. So I need earnings to really do well. I think things are okay. I still think I can find things that are going to outperform in an eroding backdrop. But I don't see how somebody could sit here today and say the probability the economy improves is better than higher than the probability it deteriorates.
No, but does it? No one's going to come out and necessarily say it's going to improve. But I feel like the base case has become, okay, well, we could get a soft recession. I mean, you don't have to have the whole thing
I got a soft recession,
do you? What if it just doesn't get any worse?
I think the part that's the least compelling, I hear you, right? I mean, I think the part that's the least compelling is simply I can buy, after tax on a, whatever duration I want, 6 months to 2 years, something that yields close to 4.5, after tax maybe, so that's guaranteed, equities don't look that compelling unless I really believe either the multiples are going to expand a ton or earnings are going to surprise the upside. So I'm not in the camp that earnings surprise the upside. So now we're talking about the multiple. That's a bit of a gamble, and that comes down to perceptions about the Fed. So you need to believe that, it's that simple. It's got to be earnings or the multiple.
But that's still the biggest problem for equities and for stock investors, that the bond market is just too much an attractive alternative?
I think so, and I think for a lot of people, it's the first time in their investing lifetime. And I know for me,
money markets too.
Yeah, we talked about in the year last May. I mean, that's when chuckleheads like me started laddering treasuries for the first time in our investment careers. I used to have CDs, and now I have a whole treasury schedule.
I know,
right?
but
so it's compelling.
It doesn't give you pause that sort of everybody is on the same side of the boat at this point? As you said at the very top, you go talk to people, dinners.
That's the biggest bull case, is that
parties.
Every top-down guy's got a maximum 4,200. That's definitely the biggest bull case. But just because everyone knows I'm ugly doesn't make me handsome. I mean, sometimes it is what it is. Like the earnings expectations are high. The rates are up a ton. Perception about rates are up a ton. The valuation went from below 15 times in October to 18 and change times now. Speculation's rampant. We got a lot of stuff up a ton from lows. So the only thing that really could be offside still is a little bit of positioning, and that's tough to play for that, dream that I guess I buy my little dream today, I sell it to a sucker with a bigger dream later. I mean, that's getting harder.
But when do you know that it's time to play for the other side of what we're in? At some point, you do.
I think that's right. I think you've got to believe that earnings or margins can surprise to the upside, or that the balance sheet repair can be massive. One of the reasons I really like energy, we've been hammering on metals, is because inventory is low, expectations are low, and they're pretty cheap. So I think that's pretty good risk reward. I'm just more worried about areas that everyone loves the stocks. There's a big inventory problem, I need to believe the economy accelerates. So I still don't think you want to buy
retail, like discretionary, which has led year to date.
It has, because it got crushed last year, and Q4 was probably.
And the consumer's been holding in.
And the consumer's holding in at the low end, but I think a lot of those stocks that miss. One of the things that's interesting about retailers in particular, even the ones that trade at 7 times earnings, when they miss, the stocks go down a lot. So I don't have that. You know what you want? You want stocks to miss and not go down. Then you say, okay, now the bad news is in the price, and somehow they show some better progress. So I haven't seen stocks that are cheap miss and hold in.
Well,
in consumer.
In consumer.
Yeah.
I'm glad you make the distinction, because we have had some stocks that initially went down on earnings and then turned around.
Like Apple.
But that's a positive sign that you want to look for.
I think yes, I'd say that's right, particularly with cyclicals or businesses where you're trying to gauge the inventory. But some of these large ones like Apple, which I'd say 80% of its returns are explained by macro factors and flows, it's not really people's view of the fundamentals are way better. I mean, I don't know how somebody could argue that it's worth whatever the analyst said, 30% more. So they're saying $750 billion, that thing's worth more. I don't know, man. There's a lot of other things that, that's a lot of wood to chop. So
you don't think that the fundamentals of an Apple are better than the fundamentals of an industrial, for example, in what is likely to be a slower economy?
I think it really depends.
You had to bet on one versus the other?
If you're bearish, I guess you're making a relative call on their estimate achievability in a 6-month view. It depends. If you're an oil and gas exposed, if you're an agricultural exposed, some industrials are going to be pretty good. I mean, I think it just depends on the end market. I just struggle with what's the long-term story there. I'm not saying, the jig is up, but, obviously, if I can look at the cash flows and look at the businesses, I can own the energy sector 5% of the S&P. I can own Apple at 5%. I'm taking the energy sector every day of the week and twice on Sunday.
So you take a cat or a deer over an Apple?
Those have other businesses besides just oil and gas, but I'll take. Well,
because you said ag. That's what made me think
I think end market's good. I'm saying some of the industrials have end market. Yeah, I could be right.
What about, why isn't energy working?
I think the last 3 Wednesday prints from the government data look a little high on inventory, so people were worried about that. I would have thought a possible catalyst could be China's GDP guidance over the weekend. It didn't really come up to be an upside surprise. So that was one of the things that maybe could have gotten us a little bit more positive. If you're looking for bull cases, it could have been, evidence that they're going to manage the economy to a higher recovery than people thought. They kind of, put a little bit of water on that fire over the weekend. So I thought that was another incremental negative. I think ultimately the call on energy is a simple one. Capital spending of the biggest 120 companies is just structurally way lower. Demand's going to hold in it. So eventually you're going to have higher prices. So if you want to make a high probability bet, it's that globally consumers will be spending more money on energy related items over the next 2, 3, 5, and 10 years. It'll steal share of their discretionary and non-discretionary spend, and that's almost a certainty.
It's good having you here.
Always good. Good
Thanks
to see
for
you.
coming back.
Yeah.
All right, that's Adam Parker joining us. Trivariate right here, Post 9.